If you are looking at your portfolio this week, you might be confused. We're in the middle of February 2026, and the stock market is behaving in a way that defies the logic of the last 10 years. For a decade, the rule was simple: buy software, buy the cloud, buy anything with recurring revenue. Companies like Salesforce, Adobe, and Workday were seen as the safest bets in the world because once a business installed them, they never left. It was the perfect business model. But look at the charts from this week. Traditional software stocks are bleeding out, dropping significantly. The private credit giants, firms like Apollo and Blackstone, who lent billions to these software companies, are seeing their safe bets turn risky overnight. Meanwhile, NVIDIA and Oracle are surging. What is happening? Are we in an AI bubble? The answer is no. We are not in a bubble. We are in a rotation. And if you don't understand the difference, you are going to lose money in 2026. We are witnessing the death of the digital moat. To understand this, we have to go back to Warren Buffett. Buffett loves companies with moats, defenses that make it impossible for competitors to steal your customers. For the last 20 years, the best moat was switching costs. If you run a company on Salesforce, switching to a competitor is a nightmare. It takes months, it costs millions, so you stay. You pay the price hikes. That is a moat. But artificial intelligence has just filled that moat with sand. The reason software was sticky was because humans had to learn the interface. You had to train your staff on how to use the buttons and the menus. But in 2026, with the rise of autonomous AI agents, humans don't look at the software interface anymore. The AI does. If an AI agent is doing the work, it doesn't care if the underlying database is Salesforce or a cheaper open-source competitor. It can migrate data instantly. It can code its own integrations. Suddenly, the switching cost drops to zero. And when switching costs drop to zero, profit margins collapse. This is why the market is selling off traditional software. Investors have realized that the seat-based model, charging $100 per user per month, is dead. If you have an AI agent doing the work of 10 humans, you aren't going to pay for 10 software seats anymore. You're going to pay for compute. And that is where the money is moving. The new moat isn't code. Code is now a commodity. AI can write code. The new moat is atoms. It is physical infrastructure. Look at why Oracle is winning right now. It's not because of their software. It's because of their data centers. It's because they have power contracts and GPU clusters that actually exist in the physical world. You cannot ask ChatGPT to generate a power plant. You cannot ask an LLM to generate a cooling system for a server farm. These are physical constraints. And in 2026, value accrues to the bottleneck. The bottleneck is no longer who has the best software features. The bottleneck is who has the energy and the hardware to run the intelligence. So how do you apply this to your own investing or business strategy? You need to perform a new moat analysis. When you look at a company, ask yourself one question. Can an AI model generate this product for free? If the product is just code on a screen, the answer is yes. That company is in trouble. If the product is a generic legal contract, a graphic design, or a basic data analysis, the answer is yes. But if the product requires physical permission, regulatory approval, or high-touch human intervention, it is safe. Think about high-touch services. AI can diagnose a plumbing issue, but it cannot fix the pipe. AI can design a house, but it cannot pour the concrete. AI can adjudicate a lawsuit, but it cannot enforce the ruling. The companies that are crash-proof in this new era are the ones that bridge the gap between the digital brain and the physical world. We're seeing a massive flight of capital from pure bits to bits meeting atoms. The sell-off we're seeing in February 2026 is just the beginning of this correction. We're unwinding 20 years of premium valuations for software companies that effectively acted as rent seekers. The rent is over. The builders are back in charge. Focus on infrastructure. Focus on energy. Focus on the physical rails that the AI economy runs on. That is where the reality is, and that is where the growth will be for the next decade.